So Donald Trump has finally announced his global tariff plans, and you know it's bad when he pulls out a freaking big ass chart. Almost immediately, the market started to tank. S&P 500 after hours is down by 2.7%, Nasdaq down by 3.4%, and there's certainly a lot of fear in the stock market right now. Because the last time the US had a trade war with everyone, it actually wasn't in 2018. That was just with China. Instead, the last major trade war was actually way back in the 1920s, where the US increased tariffs on foreign imports by about 20%, and 25 countries responded by increasing their own tariffs on American goods. This partially caused the stock market to crash by over 90% over the course of 4 years. So could this happen this time? Maybe, maybe not. Anything can definitely happen. However, if you look at what Trump has been doing over these past few months, it's not quite the same as what happened back then. That's because back then, the main goal of the tariffs was to protect US farmers and businesses from foreign competitors. But now, the reason he's doing this is because he feels that other countries have so far been unfairly charging tariffs on US exports, and he wants to punish them back. So, this is more to remedy unfair trade practices. Not just that, he also wants to use this as a revenue raiser for the federal budget, and at the same time, use this as a tool for negotiations. So what Trump will usually do is that he will first start by imposing tariffs on a country, the market panics, the other country suffers for a day or two, and after that, he will announce that a resolution has been reached. Then he will delay the tariffs for a while, after which the market celebrates. Then the tariffs either get reinstated or he will start targeting another country, and repeat the whole thing all over again. And right now, we are in the targeting another country phase, which of course causes the market to tank. Besides tariffs, another thing that is freaking investors out right now is the fear of a recession happening. So a few days ago, the Atlanta Fed GDP Now estimated that the real GDP growth for the first quarter has declined to negative 3.7%, though this was mainly caused by the increase in imports, as companies are just trying to quickly import more things now before the tariffs come into effect. So this has less to do with the fact that the economy is weakening. However, with that being said, there are a few other signs pointing to a weakening economy. For example, the number of job openings has been on a downtrend for several months now, while consumer sentiment fell for the third straight month, as people are getting more and more worried about their personal finances, jobs, and the state of the economy. Both Goldman Sachs and JP Morgan also raised the odds of a recession happening to 35% and 40% respectively. Similarly, over at the betting markets, the odds of a recession happening have also gone up as well. Add in the fact that the yield curve has also been uninverted not too long ago, which usually means that there's a recession looming on the horizon. So this is bad for us investors, right? Because in a recession, you will see unemployment go up, the economy worsens, companies will earn less money, and eventually cause stock prices to go down. Quick pause. If you are looking for the cheapest broker to start your investing journey, check out Interactive Brokers. It has the lowest fees for stocks, ETFs, options, and more. Not just that, Interactive Brokers lets you easily research stocks. Like, you want to check out companies' financials? Here it is. You want to check out analyst ratings? Here's a bunch of them. It even has free technical insights which tells you where the stock might possibly go next. So sign up to Interactive Brokers today, and let's get back to the video. Since 1945 till now, the market has fallen by an average of 29% during a recession. And right now, we are just down by 10%, which means there's still a lot more room for it to go down further, especially if a recession did come. So, what could you do to protect yourself against this possible downturn? Interestingly, amidst all this uncertainty, there was one thing that went up. And no, I don't mean the Tesla 2x short, even though it did go up. Instead, what I'm referring to is gold. Gold just hit another all-time high. This is because investors love to flock to gold during times of uncertainty. However, before you start buying gold, history has also shown that gold is not a perfect hedge, as there were times where it also went down during market crashes. So, while gold investors may seem like a genius now, if history is any indication, over the long term, stocks will give better returns than gold. Okay, then what about selling everything first and holding cash? That is even worse. Just look back at 2022. Where did holding cash get you? Sure, you could get some fantastic yields from banks and government bonds, which were giving you around 3 to 4% returns. But guess what? We were in a high inflationary environment back then, which means while you are earning a 3 to 4% return, not only did your dollar get devalued and you end up with lesser purchasing power, you also miss out on 20 to 30% returns from the markets. Plus, home prices were also going up like crazy. So, selling everything now and hoarding cash isn't a good strategy either. Then, what about all those fancy strategies, such as buying long-term bonds like TLT or switching your portfolio to the all-weather portfolio to reduce your downside risk? Again, bad idea, because this involves timing the markets. And since you aren't hardcore, you will more than likely end up timing the market wrongly and miss out on a whole bunch of gains. As Peter Lynch has once said, far more money has been lost by investors trying to prepare for corrections or trying to anticipate corrections than has been lost in corrections themselves. So, what is the better strategy then? As unintuitive as it sounds, the best thing you can do right now is to just keep investing no matter what. Even after this downturn, the perma bull Tom Lee is still unfazed. Maybe he's just crazy, I don't know. But in the interview, he mentioned that company earnings might actually hold a lot better than what people expect. This is because big companies have a lot of cards on their hands. For example, they could be using AI to boost their productivity back up. They have the pricing power to pass costs not just to consumers, but also to suppliers. And they also have the resources to move things around if they need to. Not just that, don't forget that Trump's agenda isn't just about tariffs everywhere. He also plans to introduce deregulation and there will be tax cuts, which will benefit companies and the economy. But then you'll be like, siao ah, trade war and the stock market will boom and crash the stock market. You still tell me to hold? Here's why. First, it's important to take a step back and remember that the stock market has survived events that are far worse than Trump's tariffs, such as wars, 9/11 attack, pandemic, economic crisis, and so on. And each time, the market has come out stronger than before. And it is very likely that 10 to 20 years from now, you will see this drop as this tiny little blip and wondering why you were panicking back then. Second, even if a recession did come, on average, it has only lasted about 10 months. And if you had just held through from the start to the end, you will still end up with an average of a positive 1.7% return. After that, the market would continue to give an average of 18%, 14% and 120% over 1, 3 and 5 years respectively, with the market totally being in the green 100% of the time just after 3 years. Historically speaking, of course. So keep buying no matter what. And if the stock market goes down some more, remember to say thank you to President Trump and keep buying some more. And just in case you're wondering what I'm doing, of course I'm buying more stocks now lah. I bought into Google because it's currently quite cheap right now, even when I just factor in a 17% growth rate, which is below its historical growth rate. Not financial advice of course, I'm just telling you what I bought, not telling you to buy into these stocks yeah. I've also bought into Nvidia, which is also quite near to its fair value right now, assuming they are able to grow at 25% over the next 10 years. Same for ASML, which is also cheap now, S&P Global, which is at its fair value now, and it's a very strong compounding machine, as well as Triple Q alongside with some other names, which I'll be going through in future videos. In short, there's nothing much to be worried about lah. Anyway, that's all for this video. Hope you found this useful. Like, share and subscribe as I'll be posting new videos every Monday, Wednesday and Friday.